Jim Kenney. I'm the content provider at optionprofessor.com and graduate of Boston College, and I've been in the investment business for many decades. What I'm doing today, as I do all the time, is I share you my opinions and my observations and the little things that I'm watching, and basically my views and my opinion. Okay, so let's get started here. I'm going to go through a whole gauntlet of information because there's many people out there who have many different interests, many people out there who might not be aware of some of the things that they maybe should have some interest in. So let's start out with what happens. Obviously, we had the virus thing hit and the market sold off big time. Smartest thing I heard a week ago was from Tudor Jones. He goes, the virus hits, right? First thing you should do is take all risk off your markets for the next 2 weeks. Why does he say that? Because he's saying that you don't know what you're dealing with, right? And the markets are extended. I mean, you can't get more of a double whammy than a virus and an extended market of which people don't know what's going to happen next. So obviously, the most prudent thing to do is take all your risk off and or obviously get on the short side. And see what's going on. So I thought that was pretty interesting. The other thing is everyone's blaming the whole thing on this virus thing. And let's be honest here, okay? You know that there was a slowdown already in place prior to the virus. How do you know that? Because the Q4 numbers on growth, GDP, consumer spending, and business spending are all going the wrong way. And if you look in Europe, you've got contracting GDPs in Italy and France, and you've got your nose above the waterline, in Germany and in Spain. So again, we're not exactly going through the roof here on this stuff, okay? So valuations and earnings are way behind the prices and the growth, GDP growth and earnings, and are way behind the valuations. And so when this thing starts rolling over, you've got Tom, Dick, Harry, and every other person in the market at 33.40, okay? And you had a big blow up to the upside. Again, the Fed is saying it's not QE. The entire world is saying it is. You got to at least give some credence to the Fed that they might be right, that it's not QE. And the liquidity that they added, he's already talking about fading it out after April. And this market is a 6-month discounting mechanism generally. So the market is looking at the summertime. And if the Fed's not going to be injecting tons of money, I mean, $500 billion in 90 days or so, that sounds like a lot of money to me. So again, if they're not going to keep that kind of pace and these economic numbers are not going to turn, I mean, we have to realize that there's 5 stocks that have been holding this thing up. And we all know their names, right? Microsoft, Amazon, Google, Facebook, Apple, right? We all know them. So again, you have a high concentration on these indexes because when the people are putting their money into index funds, these guys have got to keep buying these stocks because they're in the top 5 or 10, right? You got JP Morgan as another big one, right? And why did the banks go way up? Because interest rates were starting to expand, right? We were up almost to 2% on the 10-year. And people are looking for these PMIs, right, to be stabilizing and turning. And so what do you've got? You've got people that are betting on the come line that what? That the growth, that we've stabilized and we're going to see growth now, right? And that the GDP is going to pop and everything else. Now, again, by the end of the year, some of that might be going on because expectations on earnings are supposed to really spike in Q4 this year. Okay, so we could be looking at a situation where we get a buying opportunity in the first 6 months of this year, and maybe we get paid in the second half of the year. We have to see how the cards come out. But again, to put this all on the virus, I think is silly. To get people motivated to move, obviously that could be, in other words, that could be the shot across the bow that got everybody going. But there was very good reasons for people to take some of these stocks back down a bit. The other thing is obviously you can see from some stocks that the future forecast, for growth may not be that great, and Caterpillar would be a good indicator of that, particularly for international growth. So, again, this week was a big week for earnings. You had winners and you've got losers. Obviously, anything that's connected to the cloud, people are just going nuts over. And again, I saw in the aftermarket, I don't know why it didn't print, I'm going to look into that, that Amazon had gone up to almost 2,100. And obviously it went home a much different price than that. So was that a blow-off situation? A lot of these stocks had big moves up and then gave it back up. So, was that a temporary short-term blow-off? It's starting to look a little bit like that. Now, I'm not saying that when China comes back and if we get a flush on Monday, we can't have a turnaround Tuesday going into the State of the Union address. But I'm saying is that, being patient here, like Tudor Jones said, has been pretty savvy input. And everybody seems to be dying to run right back into it. I know we have a bull market going. I know the market has got the moving averages underneath and is still rising. But some of these moving averages are down 200 points lower on the S&P. And so there could be some more room to maneuver to the downside still. One other thing that I've been looking at as an indicator is the VIX. And let's take a look at it now. Okay, again, this is, getting into Scaryville. What does Scaryville mean? Let me push this up a little bit to make sure you can see it. Okay, this is the VIX, and obviously, when it gets down underneath 12 here, right, it corresponds to a very higher market. And then when it gets up towards 18, you get a correction, and then you get a rally, brings it back down. You get another correction, then back down. And we blew out 16 here. Okay, we blew out 16 and we blew out 18. Okay, and we closed at 1884. We almost hit 20. So my feeling is very much this. You are at the upper boundaries of where you want this VIX, because I'm going to show you a longer term graph now, and it's going to tell you what happens when we break 20 sometimes. And we'll go back the last 10 years to give you an idea. Okay. So, if you get above this 25 area, okay, it can get very sloppy. Above 25, boom, VIX goes to 50. That's a big, big drop in the stock market. Then you've got a move above 25 here. Boom, you went to 50 again. Another big drop in the stock market. Here you got above 20, 25, and boom, there's the abyss again. Then here in 18, you got another spike up, right? So, you can get pretty good sell-offs quickly when the VIX gets above 2025. So this is a neighborhood where we would prefer it does not get above. And if we are going to go down and test the 3,000 area or something along those lines, it would be better for everybody if we did it moderating in a moderating fashion. But the fact that it's up in this area, sometimes it does fail from here. Okay, so this 20 to 25 that it hit is sometimes an area where you can get a bounce out of. Okay, so keep an eye on the VIX. Certainly if you see it above 25, you've got to be prepared for a parabolic type sell-off, which again, I don't see that happening, but I got to follow the tape. I can't dictate the tape. I've got to follow the tape. Okay, so that gives you a little bit of idea of what's going on. Again, once we broke above the 12-14 area, the likelihood of a big sharp pullback was increasing. Let's go back to a 1-year graph and get an idea here. You see, once you got above 14 here, and then above 16, and then you pulled back, when you held this area here, that was an indication that that rally we saw back towards 3,300 was going to be temporary. And then you can see it's surrounded by higher lows. And so the VIX was a turning point here around 3,300. And then bam, you got a big, nice sell-off that you could have taken advantage of on the downside. The main key, if you're a longer-term holder, is what should you be doing with your portfolio? I'm talking about serious money. I'm talking about big money. Well, again, a lot of people are in the 60-40, 60% stocks, 40% bonds. What you want to do as you go into a higher echelon, 3,300, 3,400, 3,600 if we reach there, 4,000 if we reach there. The way you adjust your risk is you simply adjust your portfolio. Many of these firms, Vanguard, Fidelity, Schwab, whoever, they've got these portfolios pre-done, meaning 60% stock, 40% bonds. So you can obviously reduce your risk in the stock market by going 40% stock, 60% bonds. Or you could go 80% bonds, 20% stock if you thought that we were near an apex, okay? And the portfolio of 80% bonds and 20% stock, if we do have a more substantial drop, definitely has less volatility on it. To give you an idea, I've done some research on that. And, to be honest with you, I was shocked. Over a longer term basis, 10 or 20 years, you're looking at a situation where a portfolio that's 80% bonds, 20% stock, is very competitive in my view to 60-40 or even 80-20 compared to the pullback you get. Because during the drop in like '08 or when you have a big drop, you can get twice or more volatility on your principal with the more aggressive asset allocations, while on the upside, you might only be making 1 or 2% more than the guy who took less risk. So for me, I'm just thinking out loud, not that much more return and a heck of a lot less risk. It's something to look into. So if you're in that kind of game, the 60-40 game or whatever, again, if you want to reduce your risk, you simply flop those numbers around a little bit, favoring bonds over the stocks. Okay. All right. So what else this week we had, and I'm going to go through a lot of information here. So if you want to get a pen and paper, please do. We are going to, last week, we got some interesting news going on. IBM switched CEOs. The guy who's taking over is very much more familiar with the cloud business. And again, he may be the guy to get IBM going and try to monetize this red hat that they bought and try to get a little better return on investment. So keep an eye on IBM, because it could have a gentleman in there who can actually get this thing going. Don't forget, if you look at Microsoft, it was stalled out pretty good. And then they brought a new guy in there who got them going on the cloud. And the next thing you know, Microsoft is going nuts again. So as you can see, here's a chart on IBM. And you see it went up to 50. This is a stock that was dead and dying here, or going nowhere. That's why their yield is so high. You'll notice if you have a higher yield on your stock, the actual stock probably hasn't done very much. If your yield is lower on the stock and they pay an increasing dividend all the time, the reason the yield is lower is because the stock's been going through the roof. So here, again, you had a 5% move on Friday, right? And that looks like a pretty good gap up. It looks like you can say 130 is your line in the sand, right? 130 looks like a pretty reasonable line in the sand. And again, getting above 145 and 150 would be very, very constructive to this. So again, it could be a one-day wonder. A lot of these things have spiked up and then come right back down. But on a longer-term basis, with a new guy in there who seems to understand the modern technologies and where the profits are, it could be something to be interesting. And, again, the cloud business, the cloud hybrid business are the big ones going on right now. But if you want to look into where the puck might be going, look into edge computing. And edge computing is now being spoken of in some circles as the next game in town. So I'm personally going to be looking into stocks that are into that area and see what they look like, because again, AI, cloud, edge computing, and of course now you've got these ESG stocks and ESG ETFs that are getting a lot of a lot of talk, a lot of interest, and also these non-transparent ETFs. They call them ants. That's another thing to keep an eye on and keep a look into for the future, because there's a little bit of a switch going on into the different type of ETFs, and the non-transparent seem to be getting quite a bit of ink lately. So those are a couple of things as well. What I also wanted to cover here are some of the stocks that came out last week with their earnings. And you can see that, again, Amazon, everyone thinks is fabulous now. Again, a month ago, they weren't so keen on it, but they did announce earnings. And AWS is obviously going big. But their big thing was they got 150 million people into this Prime, and they are subscribers. And obviously, that's steady cash coming in to offset some of the other things that are probably not working as well, like Whole Foods maybe and stuff like that. But again, this thing gapped up, very, very big. And like I said, I saw in the aftermarket, they were quoting something near 2100, but it didn't show up on the print. They're showing 2055. again, this 2000 area, I mean, it did lose quite a bit of ground, and it's down in the aftermarket on Friday. So again, it looks like they are going to try to close that gap a little bit. But this is quite a high flyer. Look at the PE ratio of 87. So again, this is a high valuation situation. They've got to come out with numbers like that in order to keep the train going, because it's a higher valuated type thing. Another one that I heard people talk about was Facebook, and I was looking at somebody interviewed from Salesforce. Now, Salesforce, again, has been a real darling here, and it has not gotten hit too badly during this drop. You see, it's hanging in there. It starts taking out 178, though. I think then you could start gapping down a little bit. But so far, it's held in. Anyway, the CEO is being interviewed on Bloomberg, and his opinion was that Facebook is kind of like cigarettes, in his words, in that it's habit forming, it's addictive, and it should be regulated. So there's a lot of people making non-complimentary things about Facebook, and as you can see, people are hitting the exits on Facebook right now. So again, you know, the ads is where it's all about with these guys, and but again, it seems like some of the publicity on this company is not the best. So you have to keep an eye on it, and again, it rallied into earnings, and then what it did was it was buy the rumor, sell the fact, and that's basically the way it looks right now. So you have to be a little bit careful on Facebook going into the future here. Again, if it were to break underneath this 190 area, that would be a real concern. And again, at 31 PE, you know, it's not exactly dirt cheap, but it's certainly not in the league of Amazon with the PE. What else was going on last week? Let's talk about, again, everybody seems to love Microsoft, and they should, because the company is continuing to just deliver. But, you know, Microsoft, again, is another one where the valuation's up at almost 30-to-1 PE ratio. It did close that gap, and it's a great company. But obviously, you can see from the graph that it also has had a very big run, and that the volume, again, has jumped through the roof here a bit. So sometimes when you get volume, I'm showing you the volume down the bottom here, that jumps through the roof, sometimes you get a pullback on lower volume. And again, it gives you an opportunity to possibly get on board. But again, this is one of the 5 companies keeping the thing going. And obviously, it's a very, very important ingredient in most of these indexes, like the QQQs and the S&P. Apple, okay. This one here, again, is interesting because they say, I think, something like 17% of their business comes out of iPhone sales over in China. And then I had read that in the fourth quarter, iPhone sales were very bad in China. And of course, their supply chain is also in China to a lot of degree. And so this is a company that you would think has had a very big move. The 200-day average, I think, is in the 220 area, which is way down here, maybe 230 because the stock has gone up. But that's a lot of real estate between 320. Well, let me go give you the exact number. Okay, so we're at 231. Okay, this is really jumping pretty good. But we still, when we hit the high, which is 327, we were almost $100 above it, which is 40% above the 200-day average. Now, I'm telling you, you know, my experience with that is that in many cases, you are going to go closer to the mean at some point. It doesn't have to happen overnight, but you know, if the supply chains are really going to be affected by this virus, and it's going to affect their ability to deliver products, and it's going to affect their results, then obviously that could be the catalyst that closes the gap between this extended market up at 330 and where the moving averages are way down in the 230s. So there's 330 and there's 230. That's a lot of white in there. So is it going to get filled out in the next 6 months? I don't know, but I would know this, is that 327 looks like a good place to defend against if you wanted to take positions such as hedging or covered call writing or something along those lines. Using 327 as a watermark right now doesn't look like a bad idea. We'll have to see how things unfold. Again, China comes online on Monday, meaning their markets have been closed. So they're going to be reopening into what we have seen this week off the U.S. And so I don't know how things are going to pan out. Maybe they'll stabilize the market by injecting capital, or maybe there'll be a big sell-off on Monday and it could turn around on Tuesday. But at any rate, it's going to be very, shall we say, interesting, at least, to see how China opens up when they do on Monday. Okay, what else was big in the news? These are companies that did well during the earnings. The other one is the beverage company, MLDZ. And let's take a look at it. I'm going to go over the ones that did well, and I'm going to go over some of the ones that didn't do so well. MLDZ, was it? Well, let's go over, I'll go over a different one here. Hershey, HSY. This thing, again, I guess it's good to have a product that people have a sweet tooth on, because this thing has been growing and growing and growing for quite a long time. Even in the last 52 weeks, it's gone from the low of 104 up to 162 at one point. That's a 60% jump in the stock. And this is a very big company. So again, that also had good results. But again, you know, it gapped up and then it came back down. So, and it didn't take out the 160 level. So there's a company that had good earnings, and it's in the food area. Let me think of a couple of other ones here. Coca-Cola. That's another huge one that, you know, has been just growing and growing. It's gone up, well, almost $20. That's almost 50% from the low to the high in the 52 weeks. And again, though, it gapped up to 59 and it's fading just a little bit. But that obviously is a company that is just producing results after results after results. Another one was Western Digital. And Western Digital, again, similar to many of them, big run up from 35 to 72 in the last 52 weeks. That's almost a doubling of the price of the stock. And again, they don't have any PE ratio, so I don't know if they're actually making money. And then, of course, like I say, it's pretty extended. So this would be one if we broke 65. Let's take a look at the semiconductor, because that's the one that's been on fire, and that's the one that people have made a ton of money on. Let's see how it looks technically. Okay, yeah, it looks like 150 has been established as a high point. You see all those lower highs underneath, right? And we did break under the 140 area, so that's not a real positive. And so let's just see where the moving average is on this one to give you an idea of how far overbought we are technically basis the moving average.
Hey, Jim.
Yeah.
Sorry to interrupt you. Can you pull the chart a little lower?
Okay.
We can't see the chart.
Okay, very good. A little lower. I'll try to make that. Can you see it right now at SMH?
No, I don't see the chart at all.
Okay, how about if I go like this? Are you at least seeing it now?
A little bit more. All right, we don't see a chart, so.
No, this isn't a chart right now. I'm showing you what the short interest is, and I'm showing you where the.
Yes, we can see that.
Okay.
Mm-hmm.
Now, again, I'm sorry for that because I can't see what you see, but here's what I am saying here is if you look at the short interest here in this thing, I mean, this is, people are using this as a hedge. There's no question about that. That number there is just enormous. But at any rate, 121 is the moving average. And as you can see, during the advance we've seen in the last 2 months, there's your 50-day moving average of volume. Look at the volume, 3.4 versus 200-day, 5.4. So again, when you get extended and your volume's drying up, you know, again, you love to ride the car as far as you can, but you've got to know when to pull the cord. And again, it looks like people who pulled the cord around 150 on the semis, made a good decision, because again, not only does it seem like the volume's drying up, but it's very overbought basis the moving average. You know, $30 divided into 121 gives you a percentage of 25% above the moving average. That's extended. Some of them get crazy, they can go even more. Okay, let's see what else we've got cooking here as far as, okay, let's look at Tesla, because this thing's just gone nuts. And people have been riding the wave. Obviously, they couldn't be happier. But again, let's take a look just to give you an idea. I mean, this is just a phenomenon. You're looking at a moving average here of 291, and your stock is above 600. So it's 100% above its 200-day moving average. Now they say that the valuation, it's obviously bigger than GM, Ford, and all of them combined. But they're also saying that on a per car basis, the valuation is like $300,000 a vehicle versus $6,000 a vehicle for the other companies. So again, Elon Musk has the technology. People are jumping because he has longer life on his battery by X percentage, and so people are just coming in here hook, line, and sinker. But that short interest of 13%, don't kid yourself. There's been some people, and I've heard some people on CNBC saying they were short, and they just got murdered. And there was another guy on CNBC who was at a Bitcoin convention, and he was short as well, and he got murdered as well. So there's a lot of people, big money, who is shorting this company. And if you ask me, look at this graph on the left, if you can see it. As soon as it broke 400, all your shorts should have been covered. There's no reason to be in this thing. Because look, once it broke above 400, that was all that resistance, right? You don't want to be short something breaking out to the upside. That's how you lose your shirt. So again, I don't know why these people would still be short a company that's breaking out like that. Now, again, as far as now is concerned, I mean, it's the poster child of overvaluation. But again, this is more of a phenomenon than a stock. Okay, now on the other side of the coin here, oh yeah, one last company that had news on it is Altria. And it looks interesting now because it seems like they're settling up their problems with Juul. And again, this company just, prints money as far as cash flow is concerned. Let me move the chart up so I can make sure everybody can see it. And so, let's go down a little bit. Okay. Now, I'll move it up, up, up. There you go. Okay. So on Altria, again, this is a company that had a big down move, nice rally to 52, came back down to 46. This is a neighborhood where it could hold. If it gets back above 52, I'd be very interested in this because, again, it might be telling us that the Juul problems, the vaping, might be behind it. And again, this thing can go pretty well if they get their stuff together. So that was something that had news on it that I wanted to talk to you about. All right, now we've got companies that are shutting down some operations over in China, and Levi, the company, is one of them, shutting down some stores, and Starbucks was another. But again, let me just see something here. Some of the other things that got hit here last week, the biotechs, okay, Amgen, let's take a look here. Yeah, the blooms come off the rose on some of these things. That's what I'm trying to say is if you take out about 5 of those companies that I mentioned, a lot of these other guys are just not doing very good. Now, this is Amgen. Went up above 240, and look, boom. But I'll show you, it's another classic example, and this is why you want to, do this when you're investing. You want to be careful on where the market is versus your moving averages, trying to use the moving averages as an indicator of the mean. Now, again, this thing hit 250, and the moving average here is 201. Okay, so and the volume has dried up a little bit. So you had some good reasons to get defensive up around that 250 mark. And again, when you're $50 above the 200-day average, you're 20% above. Okay, and when you're 20% or better above, you're going to be in a situation where it can have a good drop, and that's basically what Amgen's doing. The other one that got nailed, I think, was Biogen. So you want to be careful here. Again, people are saying that in the second half of the year, a lot of money will be spent on medical. There'll be a lot of deficit spending. So again, you don't want to get too bearish because the long-term moving averages on the stock market are still rising. But it wouldn't kill you to be a little bit conservative about when you put new money to work. And again, not just buy the first dip. 315, and we drop all the way down here to 270. You got a big gap, and it has potential, obviously, to come back into that gap. Okay, the other things that got hit here last week is the oil market. But I'm going to get into that in just a little bit. What I would like to just mention is keep an eye on a few things that are coming up next week. Monday is Google and Cisco, SYSCO, and then you got on Tuesday, earnings in Disney. You've got in ConocoPhillips. You've also got Swap coming up. Let's want to see what, Snap, I'm sorry. Let's take a look at Snap real quick and see if there's anything there that might be interesting. Hold on. Okay. Snap. Yeah, they come out on Tuesday. And look at that stock where it is now. So they have priced themselves where they have to come out with a good report, right? Because it went up to 20 and it used to be down at like 13. So it's had a 50% jump, and not in that long of a time. You have a high there surrounded by lower highs. If you start taking out 18, which you see the high there and the high there, and now you got 18. You don't want that 18 getting taken out. So if they have earnings that don't come in properly and it breaks 18, this one's going to go into the soup. Okay. Conversely, again, the trend is up, and it did hold 18. So if they surprise on the upside, you know, blowing out of 20 is probably not off the charts either. A guy trading options might price out a strangle, $20 call, $18 put, and see which one they're going to go with. See if the prices of the options are cheap enough to make that make any sense. Limited risk on both sides, leverage on both sides, and you've got earnings coming out Tuesday. Interesting thing to look at. I'll show you another interesting thing to look at on Google, which I was looking at on Friday. Google has cloud exposure. Okay, and they got advertising exposure. Okay, and so what could you look at here? Well, here's something that I was looking at. There's obviously a very aggressive position for high net worth investors and for people that are very sophisticated, right? That's what this is, something to look at for those type people. Here you got it. Google's at 1434. I was looking at the 1400 put on a weekly basis, and it was going for about 25 bucks. And I was looking at a 1470 call on a weekly, and that was going for 25 bucks. So the concept would be sell the put, buy the call. Taking the money on the 1400 put, 25 bucks, which means what? You're agreeing to buy 100 shares of Google at 1400, which is 140 grand. That's why it's not right for everybody. Now, you're taking that premium and you're buying calls at 1470. If we get a move like we saw out of Microsoft or Amazon, which is 10 to 15% up, you could go anywhere from 1570 to something like 1625 if it got the right number, right? So what's your potential? Well, you got the right to buy it at 1470. You took the money off the put to pay for it, so you're basically long at 1470. And if you go to 1570, that's 10 grand on one option. And if it goes to 1625, that's 15 grand on one option. So that's your reward if it gets a pop between now and next Friday when it expires. Now, what's your downside? Well, if it stays between 1400 and 1470, Peter pays for Paul, meaning on Friday both options would expire 0. You have the put that you sold that you're going to keep 25 bucks on. You got a call you bought for 25, so that's where that 25 bucks is going. So it's a wash, meaning it's an offset if we're between 1470 and 1400. Now, if this thing comes out and goes into the tank, you're going to have to buy stock at 1400, which is, again, 140 grand worth of stock, and then you would be liable for everything that it goes down. So if it went down to 1300, you do the math, 100 shares times 100 bucks. But, again, some people who think that A, the pullback is overdone, B, who thinks the Google pullback is also a little bit overdone, and who believes that the earnings are going to come out right, that would have been a strategy that would have made a lot of sense because you have one put paying for your call. You've got a pretty good parameter of which to operate within where both of them would offset each other, a 70-point range. And of course, you're in a position to take advantage of a move that could occur if the earnings take it off, do a similar situation to some of the other, shall we say, darlings of the stock market. So I just thought that was kind of an interesting strategy, and from time to time that makes a lot of sense. Selling the out-of-the-money put and using the premium to buy calls. It hedges you on the upside in case the market goes way up, and it also uses out-of-the-money premium to pay for it. But you've got to be willing to buy the stock at wherever you sold the put for, and you have to have the money, the wherewithal, and the nerve to do it. So basically, sometimes when you get big drops, the puts can get very fat, and some people like to do put writing and then use the premium to buy calls, or they just like to get the strike price minus the credit In other words, if you didn't use the put premium on this example I'm showing you in Google, you would get the stock put to you at 1,400 minus 25 bucks would mean you'd bring your cost down to 1375. And so some people just like to sell puts, so they're either buying stocks at a discount or collecting premium. So again, and the VIX getting very, very, very high, that's something you could investigate. Again, a fully paid put means you're just going to be buying stock or agreeing to buy stock at a discounted price if they put it to you, or you're going to collect the premium and keep the money. So again, when you sell a put, if the market rises, you keep the premium. If the market goes sideways, you keep the premium. And if the market goes down, you get put stock less the premium. And that's pretty much the game of put writing. And what you do with the premium is up to you. Okay, what else do we have here that I wanted to talk about here next week? Okay, Wednesday, you got Qualcomm, you got Merck, GM, and you got Yum China. That'll be interesting to see how Yum China works out because, again, you know, they got the market opening Monday, and they got all kinds of problems that they're hitting with. Thursday, you've got Uber. You know, some people are thinking Uber might be a good deal here now. Let's take a look and see why they would be thinking that. Many people like Lyft better because Lyft is more U.S. oriented, and this is another one that better come out with a decent number on when they might be profitable, et cetera, because it's had a good run from 25 to almost 40 there, 38. That's a pretty good run. So again, if it takes out this point here, that means trouble. And of course, if it can make new highs around here, maybe that'll get it going. Again, is it going to be buy the rumor, sell the fact? Only time will tell. This rally, again, look at the volume. Volume's light. Big volume on drops, and then a big volume on a drop. And then as we go up here, volume dies out a little bit. So, you know, you got to be a little bit careful that it's a no seller situation that caused a lot of these things come up. Remember, you got passive investing. Passive investing means what? It means people put their money in ETFs and then they go to bed and they don't sell. They just sit there and sit there and sit there, right? So what's the problem with that? The problem with that is when they wake up and they all want to sell, there could be a heck of a lot of volume coming out and not enough buyers, and that's what you got on Friday. You got everybody wants out and there's no buyers. They just dropped the bid, and they dropped the bid pretty hard, 600 points. So again, here, if these guys do miss, all these people that are long are probably going to want to get out. And then, of course, if they want to get out, side of the trade. All right, and then on Friday you've got AbbVie, and also on Thursday you've got Wynn Resorts. Let's see what that looks like. I mean, if you're a bargain hunter, you got to start looking at BABA now, right? So let's take a look at BABA. Let's start looking at some of the stuff that China is affecting. Okay, BABA had a good pullback. Where would be a spot where BABA might be able to hold if it's going to hold? Okay, it was at 230. And again, let's go look at those moving averages real quick and find out why it's closing the gap. And how far is the gap? Okay, let's get that. We don't need to look at Don King. Okay, hold on 1 second here. Okay, you got pretty good short interest, 8% of the stock. Again, 181, right? It already broke through the 50-day, and you got 181. So how does 181 look like on the graph here? Yeah, look at 180. See those highs there? So somewhere between here and 180, this thing had better stop, right? And so that might be a good place to start thinking about BABA. Or if you like it at 180 and you want to at least, get something out of the drop in case it doesn't keep dropping, start investigating what the puts are there. If you sell a put at 180, you're agreeing to buy at 180 minus whatever you bring in premium. And if we come down here sharply, that could be a pretty good place to do that. And another thing to do would be to sell the put at 180 and then use the premium to buy a call. And maybe you could buy a call or a call spread going way out in time. And then either A, you're going to have a stock put to you at 180. You'd still own the calls way out in time. So what if it comes down, puts you at 180, and then goes back to 240? you'd be good on your 180 stock, and you'd be good on those calls you bought 6 or 12 months out if we got a turnaround. So that's something to look into right now, possibly as well. Win. Win got nailed pretty hard as well as a lot of the gamers, because again, you're looking at a company that the people are wearing masks, they're canceling flights, and all kinds of disruption to their business. So, you don't have to be Phi Beta Kappa to figure out this thing's got hit. Okay. Well, again, when these things get extended away from their moving averages, let's play the game again so you get an idea that there is some rhythm to what I'm talking about here. Obviously, nothing happens all the time, but we're all talking about probabilities here, and we're talking about odds. Okay, that's why when I talk to people who are in asset allocation models of 60-40, there's some pretty good, respectable guys that I hear, and they say, listen, the first thing you got to know is that when you're at 3,400 on the S&P, you maybe don't want to have the same exposure to stocks on a percentage basis as you did 3 to 5 years ago. So what that means is you switch from 60-40 to 40-60 or whatever you want to do. But you reduce your exposure because the odds have changed, because the prices have changed. Okay. So now what do we got? 123 was the 200-day on Win. And so basically it's right down in that neighborhood. So this 120 neighborhood would be something that would be very important for Win to hold on to. So keep an eye on Win, see if it can hold this 115 to 120 area, and see if, in fact, it's a situation where there could be some value here. It's all according, really, what this virus is going to do. Some people are saying, oh, it's transitory. And I've heard some respectable people saying it's going to have long-term effects. So, again, you have to be balanced in your view, and you have to be humble, and you have to be respectful of other people's views as well. Then, of course, you make your own decision. Okay. Let's see here. As we go into the last 15 minutes, let's go around the horn here, and let's see if I have anything else here. I went over the Bob and Win. Okay, let's look at this thing here, because I found this interesting, and let's see if you guys think. This is a relatively new, I think, ETF, and the symbol is EMQQ. Now, this is not an overnight trade. Okay, this is not an overnight trade, but it is something that is made up of things that are kind of interesting. And let me get the chart up high enough so you guys can see it. Okay, so big pullback, right? Well, look at that 34 number. That's a number that could be defended against. And obviously, again, when you go on a big run up and your moving averages are down here and you're up there, this is a time you got to be more careful, right? The trees don't grow to the sky. So here you go. And you don't know what the virus caused it. I mean, it could have just happened because, it got ahead of itself, like earnings and the GDP and consumer spending is shrinking. That's 2/3 of the economy. And so, you got to be, the numbers really, are not backing these huge runs. So anyway, it pulls back. Why would this be interesting to me? Because what do they got in it? They got emerging markets, but it's focused on tech, internet commerce, and communications. And it's got 50% in China. So obviously that's why it's tanking. But it's also got exposure to Africa, Brazil, and India. And they tell me that there's 1 billion people over in India that don't have smartphones yet. So there could be companies in these developing markets, in the tech area, and the internet commerce and the communication, who on a longer term basis could actually be worthwhile. So I just wanted to explain that might be something to investigate and then see what you think. But again, there's not that many of these things that give you exposure to to those sectors and to those countries. Africa's got, I don't know, some of the fastest growing economies in the world. Hard to believe because that's not the way they portray it on the TV, but that's interesting. And then, of course, India, we know their population is enormous, and we know they've got pro-business people over there. So it'll be interesting to see what they can do there. And the same thing with Brazil. They're trying to figure out their pension plans and their obligations, and they got a guy in there who's very pro-business. So again, those 4 countries are very pro-business at this point, and might be interesting to keep an eye on it because, again, at one point it had a very nice move from the area of 29 up to 38. So, that's better than a 35% move. But on a longer term basis, there could be some real value here. Okay. Let's see if there's anything else I've got here. Let's go through the market here. And again, I'll try to give you a little bit of insight into what I'm seeing. On the S&P. Let's get the chart up there, and let's show you what I'm seeing. Move the chart up so you guys can see it. Up. All right. A little bit further down here. Okay, so there it is on the S&P, and you're looking at a situation where, again, the nervousness now is that you made a high, right? And then, of course, you got surrounded by lower highs, so that's your indication. Again, your moving average is at 30.50 on the 200-day, something like that. So your moving average is way down here. When you're up there, you got the risk of anything sobering causing a sell-off, and that's what we're seeing. That's what we're seeing. So again, this 3150 area, okay, well, obviously 3200 and initially could bounce. That's why if we get a sell-off Monday, you could have a turnaround Tuesday because 3200 has some support right there. That's right around the 50-day, right? And then more significant drop would be to where this breakout point was, which is 3030, okay? And your 200-day moving average is in the neighborhood. So I would be prepared for this down here. And I would probably save some money to try to take advantage of something down here. Okay. And again, is it a 1, 2, 3 formation? The one move down here, 2 move back to 3,300, fill the gap. And now the 3 move can be very extended if it's going to be a 1, 2, 3 formation. So again, bull market still intact in my view, but the first quarter here possibly could be rough if the virus gets worse and if the GDP numbers and the earnings and everything else doesn't pan in. You could have a situation where further weakness is potentially going to happen. So I'd be careful. And again, up here at 3,400, 3,300, that's where you consider doing covered calls, taking in cash to offset some of your risk. Collar strategies, you sell in out of the money call, you take the premium, you buy your put, now you got insurance, or you simply just buy married puts. Again, now we're getting the VIX up at 20. Obviously, the horse has left the barn, but you've got to put on situations when it favors you. If this VIX goes 20, 25, 30, 35, and those put premiums get enormous, start pricing them out, and then either you buy your stocks at a discount or you collect the premium. Or you collect the premium and buy calls with it, and you still are selling it out of the money put. You're buying a stock at a discount to the current value. These are strategies you investigate when that is happening. Okay, so there's your stock market. With regards to your bond market, I'm using TLT as my gauge, as I always have been, okay? Again, people are flocking into fixed income, and they're doing it for a reason, because they're seeing the economic numbers are not anywhere near in connection with the values and the prices of stock, okay? Now, again, TLT, this is when interest rates hit their bottom, right? That was back in August, right? And then they were rising. Yields were rising for the next few months here, right? And then what happens in the fourth quarter is they start injecting $400-500 billion of short-term money into T-bills. Why are they doing that? Because if short-term interest rates are higher than long-term interest rates, it shows you that people think a recession is coming. And if people think a recession is coming, they stop spending money, and then you get a recession. Okay, so what they've been doing is trying to make sure that yield curve doesn't invert. And now it's getting back to trying to invert again because you're testing these high points. And that's why the 2 and 10 is getting very close. And the 3 and the 3-month T-bill and the 10-year, I think is very close to inverting. So that's what's causing concerns. Okay, so that's where you're seeing. Now, again, if we get above this 145 area, as I've said, and then take out 150, these people that are saying 1.2% on the 10-year and maybe even going like Europe and Asia, they're going to make a lot more sense because that means your yields are dropping. And maybe the Fed's going to try to play that game, although my feeling is they're going to play the balance sheet game where they print money and put it on their balance sheet, as opposed to dropping interest rates down to zero because they can see that it kills the banks. Okay, in other words, it makes the banks very difficult to make any money. One way you can just say that is just put up a company called Deutsche Bank, the biggest bank in Germany, and then you can put up a 10-year graph on it. Now, it's had a bounce lately because people are looking that it might be turning around. But look at what negative interest rates did to the bank on a longer term basis. And there you go. I'll show you as I push this chart up that Deutsche Bank used to be $60, right? Come on down here. Deutsche Bank used to be $60, and look where it is. So that's what negative yields do to the banks. And the Fed knows that. So don't look for them to make interest rates go to zero as much as expand the balance sheet, because they don't want Citigroup to look like that, or JP Morgan, or any of the other companies. Okay? And this is a combination of no growth and no interest. So if you have no growth in your economy and you have no interest in your economy, you have a very bad situation for the banks. And you know, and I know they don't want to see Wells Fargo, Bank of America, Citigroup, and those guys look like that. Okay, so that's the bond market. Let's look at the US dollar. Now, where are you going to go if you don't go in the US dollar? You're going to go to the euro with Italy and France having negative GDP. Are you going to go to the British pound, where they're trying to leave Brexit and a guy named Boris is over there trying to figure things out? Are you going to go to Japan and the yen, where they have a GDP to debt that looks like the biggest joke of all times? So there's not a lot of places to go, and that's why people are hanging in the dollar. What's my view been? My view, this is going back 10 years. My view is we're in a trading range. I say 99, but it looks like 100 to 95. Okay? When you get above 100, talk to me. When you get under 95, talk to me. Other than what? Other than that, plan on a stable dollar. And of course, that's what makes one of the reasons the stock market does good, is because we have a stable currency and we have a very big interest rate advantage. And our GDP, while at 2%, luckily, is still a heck of a lot better than negative, which is what Europe is doing. Okay? So that's why the US dollar is where it is. Let's look at the next thing, which is crude oil. Okay, this has been a very bad place to be. Why? Because the demand for this stuff is not that high and the supplies are really big. My assertion on it was that the Aramco deal, they would prop prices up. I've been saying that for a year. And when Aramco, the Saudi Arabian issue came out, we had the oil go up towards 60, 65, right? They sold about $2.5 trillion of stock, right? All sold. Now, all of a sudden, the prices are back to 50. I mean, come on, let's use our common sense. The prices went up to finance that deal, to get people interested in buying $2.5 trillion of a stock in oil. And now that that has been done, look at what happened to prices. So now you got to be very careful on triple C debt, which is low quality junk bonds. These companies that issued it in the oil patch, they don't have the free cash flow to make their payments. And if we're not at 65 or better, they don't have the prices helping them. So this could be a semi-crisis. And that's why you see Royal Dutch talking about their dividend, and it's gone down. You've looked at oil. I'm sure COP may have trouble this week. You saw Chevron had trouble. Exxon is looking like it's going south. So they're all in trouble here, and it better hold on to 50. Because if you take out 50, there you're going down, and that's a lot of consolidation that is breaking down. So let's hope that this 50 holds if you're bullish. You obviously are hoping for that very badly. But again, and of course, it could be darkest before dawn. So don't get too negative if it doesn't break 50, because you actually could be looking at good value here. And again, I'm sure the put options are very fat in the oil stocks, so that would be something to investigate as well. So there you go on the oil situation. You got to hold that 50. The stocks are tanking. You price out the puts. If you're a long-term bull on the energy market, maybe you try to take advantage of some out-of-the-money put writing. If you're not, stand aside. And if you're a momentum player, it's way too early to get involved because there's no upside momentum as we speak. All right, gold is the big key here, and I'm glad we're going to be closing out on it because it's going to have a very important week this week, in my view, in my opinion. This is GDX, and you can see 30 area has been problematic. If we can blow out, it's at 29, hit 29.25. If we can blow out 30, then I think GDX has a pretty good shot at taking off, and then the gold has a pretty good shot of blowing 1600 out and going on a run. So gold, I think, is on the ledge. It's either going to have the legs to break out, and I was looking at the moving averages. They were way underneath the market, but they've caught up. The 200-day moving average on gold's 1464, the 50 days at 1521, and gold is trading at around 1580. So the moving averages have definitely gotten caught up a bit. Now, again, albeit they're still below pretty well. I mean, you're $100 underneath in the 200, so there's room for it to correct. But if it can get above this resistance, and what about the juniors? Let's get the chart up a little bit here for you. The juniors the same way. If we can blow out the highs here on the juniors, this thing could start accelerating a bit to the upside, 43.23. So you're very close to a possible breakout in the gold, but it hasn't done it yet. And there's been a lot of activity in it. So if you see it failing, be prepared for it to maybe go down and test some of these lower averages, 50-day 1520, 200-day 1464. Keep an eye on the gold. Again, you know, I would be, you know, if you have a core position, I have a core position in full disclosure. I'd be interested in adding on a breakout. I would not be interested in adding until I see the whites of their eyes as far as the breakout. So keep an eye on it. Like, hey, listen, they're printing money. We have got the negative real interest rates. What does that mean? Inflation is running 2% or better, ballpark figure, and you're getting 1.5% on the 10-year. Again, that's generally when gold blows out to the upside. So that's why I'm saying keep an eye on it this week. There could be something happening because we've got negative yields, meaning the inflation rate is higher than the interest rate. Not a lot. When it was a lot, it can really go, but it has happened. And again, keep an eye on it. This week could be very interesting. Again, you know, some of the negatives on gold is that the inflation numbers are not that high, and B, the dollar, as you saw, is very firm. That's strike one, strike two. Okay, but if people are and it starts feeding on itself, again, that's where the situation could be quite good. All right, so keep an eye on it. That's one of my ones that I'm focused on. We are coming to the top of the hour, and what I would let you know is that if you have any questions you'd like to speak to me about, and you'd like my opinion or my observation on something, feel free to contact me at optionprofessor@gmail.com. That's optionprofessor@gmail.com. I'd be more than happy to share my opinion and my observation if you'd like to put it into your mix of information that you get from all different sources. Again, it's been a very good pleasure to be with you. There's a lot of great information I think that you're hearing today. I hope I was able to add some detail to you, give you some of the macro view as well as the micro view, and again, maybe put your attention into areas that you might have neglected, and maybe hopefully brought that to light. Again, I'm Jim Kenney. Thank you very much for being and listening to us here today. And again, the next speaker will be coming up in a moment. I'm going to turn it back over to Anka and David. And thank you guys very much for having me today.
Thank you, Jim.
Thanks, Jim. Amazing presentation as always. And